Hi, everybody. My name is Jeffrey Scott. I am a loan officer with New American Funding. I've been doing this for about 18 years. My prior career was in commercial real estate as a broker with Grubb & Ellis and Lee & Associates Commercial Real Estate. So I understand the brokerage side of the business, and now obviously after 18 years, I understand the home loan or the mortgage side of the business pretty well. And what I've decided to do a couple of years back was design a class for realtors to speak about the mortgage process that will help the realtor understand how to set the expectations with the client or the customer at the end of the day. And I believe that it's super important for all of us to understand all of our roles, because when problems arise, it's nice to be able to be helpful and to solve them. And time is money, right? And so the more I know and the quicker I can solve a problem, the more transactions I can close at the end of the day. At least that was my philosophy. And so let's go into this is the first of two classes that is available to you. And this one's going to talk about the loan process. And then it's going to talk about the three silos of loans that are available to customers today. And I'm pretty confident that most loan officers don't even know about the other two silos, but most definitely the third silo they're completely unaware of, because it's a very niche-y product that we have. So with that said, I'm going to throw something out that's kind of fun. How many of you can guess, you all guess, how many people does it take to close a loan? How many individuals do you think it takes to close a loan? Do you think it's 4 or 5? Do you think it's 5 to 10? Do you think it's 10 to 15? Do you think it's 15 or more? Well, it's kind of a fun question, because a lot of people don't, I see an answer of 5 in chat. A lot of people don't know this, but it takes anywhere from about 17 to 19 or so individuals to close one loan, right? So you have the loan officer, you have the loan officer assistant, you have a processor, you have a junior processor, you have the underwriter, you have the escrow officer and his or her assistant, you've got a title officer and his or her assistant, you have an appraisal management company that hires the appraiser, you have the lender appraisal review department to review the appraisal, you have a fire insurance agent, you could have a condominium project manager, as well as a lender condo project review department reviewing the project, the condo project. You have a doc draw person to draw the docs. You have a notary, you have a funder, you have a wire department. And at the end of the day, you've got somebody recording it at the county recordings office. So it's almost a miracle these things get done, right? When you've got to organize that many people. So with that said, let's move into the loan process for the consumer. And I'm going to try to teach this briefly so you guys get kind of a good idea of if the customer asks you questions on what to expect on the loan process, you'll be able to rattle this off fairly easily. Write this down, jeffreyscott@naf.com. The reason is midway through, we're going to have a thank you drawing, and I'm going to have you email me. So email me at that address, and midway through this presentation, I'll explain why. But moving into the first step of the project, or of any loan, is documentation of the loan. And documentation of the loan starts with the loan application. The loan application starts online 9 out of 10 times. On some occasions, I will take an application over the telephone. I literally take it handwritten, and then I will put it into the computer system for them. It's not uncommon. A lot of people don't want to do it over the online, but in today's market and with computers where everybody are with the experience that they have today, they can pretty much knock out a loan application in 10 minutes. It's just not that hard. Once the document is in the computer system, then I can review it. It comes directly to me, and I can pick and choose the actual physical financial documents or financial statements that we're going to need from the customer. And they're broken down into 3 categories. So just keep this in the back of your mind. It's the property documents, it's income documents, and it's asset documents, right? So those are the 3 groups of documents, or the 3 categories of documents that we need to collect. If it's a purchase transaction, we're going to collect the RPA, the residential purchase agreement. We're going to collect a quote from a fire insurance policy company, a fire insurance company, so we know what the insurance fees will be. And if it's applicable, like if it's a condominium, we'll need the HOA name and contact information. If it's a refinance, we're going to be asking for the homeowner, the current homeowner's fire insurance deck page, the current mortgage statement, the current tax bill, and if applicable, what does that say? Oh, the current HOA statement. So those are your property documents that we're going to gather on one of those 2 transactions. The income documents that we're going to gather will kind of be dependent on what it says on the application, and I'll know exactly what I'm going to need to ask them for. But in general, it's going to be 30 days of pay stubs. It's going to be 2 years of your W-2s. And then it could be 2 years of your 1099s if you're self-employed, or your K-1s if you're self-employed. And it would also include, if you are self-employed and you have a corporation, your business tax returns. And those are either your 1120s or your 1065s. And then your asset statements. And asset statements, just think of those as bank statements. Bank statements are going to show where the down payment's going to come from. If it's a purchase, the bank statements are also going to show cash reserves, which sometimes are needed, not always. It depends on the loan size and the credit score in most cases. So that's your documentation. There's miscellaneous documentation. And what's cool about this is I just thought I'd teach this because it'll give you an idea of why we need it. Identification is self-explanatory with driver's license or passport. Earnest money deposits, self-explanatory. You know, if it's a purchase, we need that, or the wire transfer. But why do we need the terms of the withdrawal on a 401k program? Well, the terms of the withdrawal explain how much the customer can take out of his 401k and under what terms he can take it out. Generally speaking, it's about 50% of the 401k balance up to 50 grand, but not always. So that's why that's always needed. A divorce decree is important because it could have alimony and child support attached to it. And that would subtract from the customer's income if they have an alimony bill or a child support bill. And notice those are judge stamped. If you're in the middle of a divorce, it gets really messy to do a loan because nothing's finalized and the underwriter doesn't know what to put. So it's much easier once it's a judge stamped divorce decree to move forward with it. Some people get their income from Social Security or pension. So there's going to be an awards letter that'll be needed. Some people put their title is how they vest the property in a trust. So we need either the full trust agreement or the trust cert. If the customer has gone through a bankruptcy in the last 7 years, we need the discharge document, judge stamped, showing it's been discharged. If the customer has multiple rental properties, this can get convoluted, not complicated, but what it does is we need the lease agreement on the rental property, the tax bill, the insurance bill, the loan statement, and if it has an HOA invoice. If the customer has 10 properties, we're going to need that each document for each property for all 10. Okay, so that can get, I mean, you could get 40, 50 documents just right there. a lot of times when the customer is self-employed or owns a business, we're going to need business licenses, CPA letters explaining certain things, profit and loss, current profit and loss statements, balance sheets, stuff like that. And then a little known thing is that on the credit report, if a father has co-signed for a daughter on a car, or if a sister has co-signed for a brother on a car, if we can prove that the person who's driving the car is making those payments, if we can collect 12 months of those statements, we can actually remove that debt from the borrower. So just a little side note that you may run across over time. So that's all of your documentation that needs to be gathered. Just remember property, bank statements and income, property assets and income, and then those miscellaneous documents. Next, we're going to talk about the loan process. And this is where it gets, I hope this helps you guys out, because this is really where it gets convoluted, because you don't understand the process, and we know the customer doesn't understand the process. So if we can help educate you on the process, then you'll be able to help to educate the customer. And we can, if we communicate and we tell everybody constantly what's going on in the transaction, there will be no delay at closing, ever. There should never be a delay. It's when time goes on and people aren't staying on top of the process. So I'm married to this process. I manage my team closely to this process. So the start of the process is after we have the loan application, after I've structured the loan, after we've collected all of the documents from the customer, then we push it into processing. And what processing does is a whole bunch of back loan stuff. And they do, let's see, where did I write that down? Well, they do the fraud alerts, they do the credit report, they match the liabilities on the credit report to the loan application. They do, they order the IRS tax transcripts, they check to see if it's in a flood zone. The processor does the income calculations, whether they're W-2s or 1099s, and the pay stubs. And if you have a nurse who's paid overtime and weekend time and double overtime, and that all gets averaged out over either a 12 or a 24-month period. And they pre-underwrite. They're kind of like the gatekeepers between us and the underwriter, although I can speak to an underwriter and do, which is really nice at our company, New American Funding. And because we can solve problems quickly that way when I can just get straight to an underwriter. And the processor pre-packages and literally pre-underwrites the file for the underwriter. So when it goes to underwriting, the underwriter is the next step or the next milestone. And the underwriter is basically verifying all of the documents and what we have set up in the computer as correct or verified as true. So she's looking at tax returns, pay stubs, bank statements, everything that we've submitted her, IDs, and she's basically has a manual, right, of Fannie Mae, Freddie Mac, or jumbo guidelines. Those manuals are about 1,200 pages. She has to literally know every page. It's a very complicated job, and she's constantly referring back to it. But then her job is to make sure that the loan is approvable for Fannie Mae, Freddie Mac. And a lot of this is done on the computer, not all of it. And that's why the underwriter is in the middle of it. Once the underwriter reviews the loan, we're going to get what's called a loan approval with conditions. So when I call out to you, congratulations, your customer is approved. What that means is congratulations, your customer is conditionally approved, provided they can satisfy these conditions. Okay, so even though I have a loan approval for you and you feel 100% confident that a loan approval means I can close the loan, the truth of the matter is that if the customer can't satisfy the conditions that are called out, we can't close the loan. And so this is a real critical milestone where I'm going to be in bed with you and the customer 24/7 to say, look, these are the conditions we need to meet. And those conditions could be things like, I'm missing page 4 of the Bank of America bank statement. A condition could be your 401k statement is too fuzzy. The customer or the underwriter can't read it, redo it. Conditions are because you're self-employed, we have your tax returns, but now we need a letter of explanation on these large losses, or we need your profit and loss statement or balance sheet. And if it's in the middle of the year and they give us last year's, that's no good. We'll take last year's, but what we need is a year to date. So now the customer is calling up his CPA or his wife who does the books, or him if he does it on some computer software, and he's got to create those documents. So conditions, generally speaking, are easy to solve. I'm missing a pay stub, or the pay stub's out of date, or the bank statements are out of date, or it could be a million things, but generally speaking, they're not hard to solve, but they are still a deal killer, because if the customer can't solve it, they can't get the loan, right? The next milestone is obviously we meet those conditions. I work with you, I work with the customer, we get those conditions and we send it back to underwriting. Underwriting reviews it one more time and says, all right, you met all the conditions. I'm now giving you an approval. And this time, after we've got the appraisal in, or the HOA project approval in, and all the other documents, the next milestone is what's called clear to close. And that's really what you want. When you have clear to close, then we know 99.8% out of the time that loan's going to fund and close easy from here on out. The customer dies in the middle of the project, or in the middle of the transaction, that's a different story. But clear to close is what you want. We call it CTC. Keep that in the back of your mind. To get there, we're just hitting milestones on the way. The loan process is very easy. I promise to make it very easy on you and also make it very easy on the customer. We need your patience, though, because when we're asking for these documents, what we find is the customer's patience run thin. Like, why do you need that? Well, I can explain to you why we need every document we need. It may not make sense to you, but it makes a lot of sense to the underwriter. That's the important thing, because we have to get the underwriter to buy off on it and approve the loan. Once we get CTC, the next step or milestone is that the escrow officer and the loan funder have to balance. Now, this can take a day or two because you're in line with 24 or 50 other files, right? On any given day. Now, it's not that busy right now. You're right, but you're still in line. And so once we get CTC, we want to order the loan documents as fast as possible. We can't order the loan documents until the escrow officer and the loan funder balance out. They have a CD that has to be balanced to the penny prior to us going to loan docs. So we're dependent upon what their volume looks like on any given day to kick that out. A lot of times I can get loan documents out within 24 hours of CTC, and that's what you want. And we're always striving for CTC a week early before closing, because my team and I don't like the stress of the last minute close. We like to do all the work up front. We like to do it all right up front. And that way, it's just an easy transaction throughout the end. And if you want to close 4 or 5 days early, we can. You just tell us. Once we order loan documents, then that can take another day to get into escrow, depending on volume. So most of the time we can kick out loan docs. I mean, you've heard of stories where literally, if I can leapfrog, I can kick loan documents out in 2 hours. right? And get them to escrow. And we do that on occasion. We do it when it's a rush, and we do it when it's needed. And if you have a good reason for it, we'll do it for you. Most of the time, it takes an extra day to get them into escrow. From there, the escrow officer will assign a notary, and then the notary will make the appointment with the customer to sign the loan documents. Once the loan documents are signed, they're returned back to the escrow officer. That takes another night, right? Another 24 hours. And then depending on the escrow's volume that morning, we could get loan docs back first thing, or it may not be till the afternoon. And we do fund off a faxed copy or a scanned copy. So we don't have to have the original inked copies. As long as the original inked copies, the wet signatures are back to the escrow officer, we can fund. And then it goes to the recording office and they record and we're done. So I'll check chats real quick. Sorry, I just kind of blew through all that. Give me 2 seconds here. Hi, everybody. Good afternoon. Dropbox class. Okay. Emails. Okay. Does the cosigner rule apply to house cosigner as well? Okay, I think this is pertaining to if a husband or a wife co-signed on a loan for an auto loan is the most common one that we see for either a sibling or a sister or a brother. Does it affect the co-signer? And the answer is yes, absolutely, because if we're taking think of it doesn't affect the co-signer, meaning, okay, there's a couple ways to actually look at that. I'm probably going down a rabbit hole, making it too complicated. Number one, whoever is trying to get the loan, it does not affect the co-signer on that loan. So if it's a husband and wife team, no, it does not affect the wife because we're removing that debt. If it's the co-signer on the car, no, it doesn't affect that at all because it has nothing to do with the car loan at all. What we're doing is we're removing the liability off the car loan liability off the borrower's application with 12 months of verification that somebody else is paying it. Cool. 2, California has extended tax due date until October 23. That's correct. Therefore, do you consider the last 2 tiers of tax years 2021? Yes. Yeah, that's correct. So we would take 20 and 21's tax returns, and then let's see. It says California's extended tax returns. So 2022's taxes, you're right, are not technically due until October of this year, but we need the extension. So you've got to prove that there was an extension filed for 2022. And then in that event, we would take 2021 and 2020 tax returns. Cool. Let's see what's next. Can you please explain what balance closing disclosures? Okay, so I think this question is reflecting, I think it's this, whoops, what did I do here? Okay, here we go. So I don't know how to point to this unless you can see my mouse. It says escrow officer and loan funder balance closing disclosure. What it means is that back in 2015, the TRID laws rolled out to protect the customer. And one of the things that they wanted us to do, the lenders, were to provide an accurate closing statement to the borrower up front on day one with no changes throughout the process to closing. And where that got super complicated is because the escrow officer has her or his own set of fees and expenses, and title has its own fees and expenses that we don't control. And county recording taxes and county recording fees and SB 215, which is the refinance tax of California. And there's all these other expenses that crop up in a transaction that the lender not necessarily controls but they want us to tell the customer about, right? So what we do is we prepare all of our lenders' fees and credits and costs, and as well as the escrow department does theirs on their buyer settlement statement. We do it on a CD, a closing disclosure. The closing disclosure is sent to the escrow officer, and the escrow officer sends us their statement, their statement for their fees. The balancing is making sure we get to the penny at the end of the day. And there are tolerances for mistakes, like you can be off by 10% and there's no problem. But if you're off by 20%, then you may have to redisclose. And these are state laws and federal laws put in place by the 2015 TRID Act. So escrow officer, funder, balance, then they can release the loan docs. Did that answer your question? And if not, just throw something in chat. See if I got everything here. You please, to clarify my previous disclosure, the brother was on. Okay, do me a favor, take down my email address, shoot me an email. We'll jump into that at a later date. That's a pretty niche-y question. Don't want to kill the time on that. Glad to spend all day with you on it. Email is jeffrey.scott@naf.inc. Here, I can just throw it in here real quick. jeffrey.scott@naf.inc.com. Bam. You guys got that okay? Okay, great. I wish I could communicate with you and make it a lot easier. And I kind of feel lonely on this side of the screen, just so you know. It's not as fun because I can't communicate with you. All right, so let me just check chat. Okay, we look good. Great. Thank you very much for that, Elsie. All right, so that's your loan process. The loan process runs very, very smoothly, provided you're hitting all the milestones in a timely manner. A lot of times when 3 or 4 days go by and you needed something from the customer and then you have to circle back to the customer, that can stall this process. Therefore, my team and myself, we're on it. We know exactly what we need every step of the way. We're going to share that information with you so you can be on your customer as well. And you won't be blindsided if the customer takes 5 to 7 to 12 days to get a document back and now we're not closing on time. You'll be in the middle of it, right? So that's our promise to you. NAF cash, I'm going to circle back to. And I told you at kind of at mid-break that we would do a little thank you for attending drawing. Okay, so what we're going to do is if you will email me at jeffrey.scott@naf.com, and in your subject line put "pick me." We're going to give out 6 drawings for $25 gift cards. I couldn't go over $25 simply because it's I guess it's the rules of the game today with the way the laws are written. And my wife works for Strauss Family Creamery. It's an organic creamery out of Petaluma, California. We believe that their vanilla ice cream might be the best in the world. So we're going to throw in 2 drawings for a free quart of Strauss Family. So anybody that's interested, shoot me an email in the subject line, "pick me," and we'll get that drawing out and we'll let everybody know who wins. And there was only 30 attendees and we figured probably 15 are showing. So you've got an excellent chance of picking up something. All right. This section is pretty important these are the 2 most important sections I think that the realtor needs to be consciously aware of with their customers today. The one that we just went through, really, the loan documentation, you just know you need a lot of paperwork. But the real important one was that loan process. That process, so you understand each step, and you understand why there's delays, and you'll understand, the step by step by step by step. It's kind of like a an automobile manufacturing plant. You can't get from this step to this step, or you can't get this step to the end of it without doing everything in between. And that process is what we're going to walk you through, as well as the customer through, and communicate every step of the way. But this section, I find this the most fascinating section of all of lending, really. And what it is what are the three silos of home loans that are available to the consumer today? There's actually three distinctly different silos. If you go to Chase, Wells Fargo, Citibank, B of A, your top 10, you go to any commercial bank and they're going to only be able to offer you one silo. Okay. And it's the tax return silos, silo number one. Credit unions are the same way. If you end up going through the wholesale channel to a broker, you will be able to offer two silos in most cases. At New American Funding, we actually offer all three silos. And the third silo is not hard money, okay? You could call hard money a silo, but most people don't want to play in hard money because it's super expensive at the end of the day. Let me walk you through the silos, explain them to you so you've got a solid understanding. So when you talk to a customer and you understand his predicament or his unique circumstances, then you could say, well, I can't fit him here, but I can fit him here, or I can't fit him here, but I can fit him here. So this is what's available to all consumers today across the board. The first one's the tax return loans. And these are home loans that require verification of income through pay stubs, W-2s or 1099s or K-1s, and tax returns. This became it's called a qualified mortgage, and this is a result of the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act. What the act wants to do is to protect the consumer from himself. Meaning, we have to prove the ability to repay the loan. No more stated income, no more stated income, stated assets. That all got pushed to the side. So your lenders today, or your investors at the end of the day, are Fannie Mae, Freddie Mac for almost all conforming loans. A conforming loan is a loan that fits the conforming guidelines for Fannie Mae or Freddie Mac. And they're generally about $726,000 in loan amount or less from coast to coast. FHA loans, VA loans, USDA loans for the rural community, and jumbo loans, all are going to require full documentation. These loans, when I call them qualified, cannot by law be interest only. They can't have a negative amortization. They can't have a prepayment penalty nor a balloon payment. They can't be longer than 30 years, although take note, FHA is considering a new 40-year loan. It's not rolled out yet, but it's not far off. So when this was put in place, these laws in 2015, no loans over 30 years, they have maximum debt to income ratios, again, to protect the consumer, and they have limits on upfront bank fees and points. And so we have to abide by those laws for tax return loans. Okay, so that's silo number one. What happens if the customer can't qualify for the loan using his tax returns? And the reason that question is an important question is because if they're self-employed, a lot of times they write off heavy expenses, so their net income is tiny, so they pay a lower tax amount to the IRS. It's a game that's played all across America with self-employed people. But we know self-employed people, which make up, more than half of today's, well, I don't know if it's quite more than half, but they make up it makes up at least 40% of all the loan volume out there. They're still good borrowers. They're still can make the payments and do make the payments, but without the use of tax returns, where do they go? And by default, they go to the no tax return loans. So this is an interesting one. What is a no tax return loan, right? So because of the 2010 Dodd-Frank Act, we still have to prove the ability to repay, right? And it's consumer protection. We can't by law give a customer a loan that he can't repay, because that's what they blamed the 2006 mortgage market meltdown for, 2006 and 2007, is that we were doing mortgages where people should have never gotten the loan because they didn't prove the ability to repay. So the ability to repay is a big thing. Wall Street and the Wall Street investors came out with different ways to verify income without the use of a tax return. Okay, so here are the ways that you can do it. We can do loans, jumbo loans up to, $5 million with a W-2 only and pay stubs, but no tax returns. We can do 1099 only with no tax returns. We can collect the customer's 12 or 24-month bank statements, and we can go through the bank statements and we can identify the deposits, and we can call those deposits income. And then depending on what type of business it is, there's they will deduct the expense ratio off that income and then give the customer that final net income for qualification purposes. So I'm doing a loan right now for a contractor. He's a 1099 contractor. He has a contracting company. It's an LLC. His employer is a bigger contractor. It's McGuire, which is a mammoth contractor up in LA. He is not an employee of McGuire, but he is contracted with McGuire and he gets a 1099. But McGuire pays all of his office expenses because he can go into the McGuire office. He gets a car allowance for all of his travel. He gets hotel allowance and food allowance when he goes out of town on projects. And he has all of his expenses covered. In this particular case, we're going to take his 1099s and we're going to only subtract 10% of what that number is and give him 90% income for qualification purposes. So that's kind of a cool thing. I see a chat popped up. Sorry about that. Let me shoot back in here. What is the jumbo range and cap? Jumbo loans are anything over 726,000 from LA to New York in every state in between. There is another level of tier of loans. They're called high balance loans. So in high rent districts like Los Angeles, San Francisco, Dallas, Seattle, New York City, they have what's called the high balance loans. And depending on the county, you could go up to $1,089,000 for the loan amount. So you could, if you just keep this number in the back of your mind, 726,000 is your conforming limit. $1 over that by default falls into a jumbo category, and a jumbo category can go up to $5 million in most cases. 3.5, a lot of lenders. We don't see a lot of loans much over 2.5 to 3 million anyway, because they're an all cash player at that time. At that point, these 15, 17, $20 million homes, they're all cash. People aren't getting loans on those. If you're in a high rent district like Orange County and you're buying a house and the loan is over $726,000, you have the option to go jumbo, or you have the option to go high balance conforming, which is also a Fannie Mae Freddie Mac loan, and that goes up to $1,089,000. Cool. So looping back to no tax returns and still requiring the ability to repay. I just finished the 12 or 24 month bank statement using the deposits for income and trying to explain that, you know, if it's a manufacturing plant that the guy owns and he's got 100 employees and these huge stamping presses and huge materials that are coming and going, so his inventory is huge, and is that's not going to be a 10% expense ratio. That could be a 50% expense ratio. That could be a 75% expense ratio. It just depends on the industry and the type of business the guy has. Okay, if we're doing the 12 to 24 month bank statement program. Another way you can qualify, and I think this one's really cool. This is great for retired people and wealthy people. It's called the asset qualifier. And what that means is, for example, if you have $3 million in the bank, we can divide that by 10 years and we can give you $25,000 a month for income. And most people, obviously, you know, $25,000 a month in income will cover most mortgages out there. So if the guy's got 10 million in the bank, he can buy even a more expensive house using this process. So it's called an asset qualifier. It's also called asset depletion. If I go down to 5 years, that's called depletion. It's asset depletion, and I can actually divide the customer's assets by 60 months, which gives him even more income, gives him 50 grand a month. So that's an alternative way of qualifying on a no tax return loan. The next one is pretty interesting. It's called a DSCR loan. It stands for debt service coverage ratio. What that means in layman's terms is, if the customer is buying a rental property, that we will underwrite the loan based on the projected rents that the property will throw off. So we're not looking at tax returns. We're not looking at pay stubs. We're not looking at assets. We're not looking at 1099s or W-2s. We're only looking at the projected rental stream that it's going to kick off. So that's a really cool loan for investors. We like to see the rent covering all of the expenses, the loan amount, the taxes on the property, the fire insurance policy on the property. It doesn't have to cover 100%. It can actually be less. And if it is less, then that's okay too. We can still do the loan. What there is a premium on the interest rate, but the loan can still be done. And that's the important thing. And it can always be refinanced at a later date. We can do a combination of these products together. So I can match bank statements with assets, with Social Security or retirement income, with DSCR income. I can combine these ways of creating an income stream at the same time. It doesn't have to be one or the other. We can group them together now, which is a really cool thing. And then investor cash flow, it looks like I've got a typo in my slide because we've already covered that once before. Cool. Okay, if a home is for sale, has an ADU or a JADU, can the home buyer qualify under DSR? Pretty niche-y. Email me on that one if you would, please, Abe. You have different criteria for investment property loans. When I did mine in 2017, they require 30% down. I wonder if that will still be a requirement today. Okay, so investment properties do require, let's see, the conforming. So it depends on which loan you're talking about. I believe that Freddie Mac might be able to do, and this is a conforming loan, they might be able to do like a 15% down payment. Don't hold me to that, but for some reason in the back of my mind, and these numbers change all the time, and that's the problem with this, but they may, Freddie may have a, and I might even have it if I can find it, a 15% down payment on an investment property. Most of the time, Fannie and Freddie are at 20% on an investment property. Let's see if I can. Yeah. So if it's one unit on an investment property, we can do a 15% down with Freddie, and then Fannie wants 25% down. These other loans that we're talking about, the DSCR loan, you can get in with 20% down payment, but the pricing is better at 25% down payment, and the pricing is even better at 30% down payment. Okay, so again, and then jumbo loans, it changes completely. So there's that. Let's see. So what happens now if your customer cannot use silo number one's loan and cannot use silo number two's loan, but still wants to buy a property? Okay, so check this out. This is mind-blowing. I love this stuff. The government, in its infinite wisdom, wants all customers who want to own a home to be able to have financing to get a home, right? So they designed Fannie Mae and Freddie Mac. So every individual between Los Angeles and New York City are treated fairly and equally. But what happens about the guy who still wants to buy the house, but he can't get a loan in the other two buckets? Here's where we put him. This is a very little known United States Treasury loan. It's still a United States government loan. It is still backed by the government, and it falls under a department called the CDFI, or the Community Development Financial Institution. It is for people for whatever reason cannot get a loan in silo number one and silo number two. This loan is exempt from the ability to repay rule. This is the only loan that is exempt from the ability to repay rule. Okay. I don't need any income documents on this loan. So that means I don't need tax returns at all. No pay stubs, no W-2s, no 1099s, no nothing on income. Keep income out of it, right? It's called a no ratio loan because I can't create a debt to income ratio without the income number. So we throw it out. But here's how you qualify. You need to have a decent credit score, 660 or better. 720 is the best in this particular loan. And you have to have 18 months of cash reserves to cover the loan payment, the taxes, the insurance, and if it's a condo, the HOA fees. Okay. So 18 months is a fair amount of reserves that you've got to have built up in the account. If you have those reserves, you can buy a house up to $3 million loan amount. So that's even a higher price, but the loan will go to $3 million. Wait, I think they changed that. 2 million. Yeah, they've dropped it. It's back to 2 million. You can get a loan up to $2 million, but that covers virtually everybody out there. There's very few people that can afford a home over $2 million. So this really applies to most of America, 95% of America. If you have 18 months reserves and a 720 credit, you only need 20% down to a $2 million loan amount, and no income docs whatsoever. If your credit score is fair at a 680, you need 25% down payment. Okay, so they want bigger down payment for a riskier FICO score. And then if your credit score is only 660, which is quite frankly a below average credit score, they'll still do your loan, but they need 30% down to adjust for that. So that loan is our home run loan. I bail customers out all day long on that. The interest rates on all these loans, starting from silo 1 to silo number 2, it increases for silo number 2, and then it increases again for silo number 3. But if you're self-employed and you can't qualify for a loan, the interest rate is not going to break your back, because on the other side of the ledger, your tax bill to the IRS in most cases is way lower than most people, right? So you're not paying exorbitant taxes, and the lender is taking on a riskier role to give you this loan. So they're going to demand for the higher risk a higher rate. But at the end of the day, you're probably still coming out way ahead, because you're not really paying. You've run through so much of your expenses on your income statement that you're paying a very small tax margin at the end of the day. So just remember, self-employed people, generally speaking, have big expenses to reduce their taxable income. So if they're not paying 35% on $100,000 in taxes, they can afford an 8.5% interest rate, if that makes sense. So, and I can walk them through the numbers and walk you through the numbers. Okay, questions here. What is the typical rate difference between 1, 2, and 1? It all depends on the credit score. So we mentioned that we were going to teach a class, second class. And in the second class, we're going to cover loan structure, down payment, pricing, and underwriting. Okay, so that's next Friday at 12 o'clock. This class gets a little more in depth and in the weeds for those of you who are really interested on how loan structures work and how do we figure out what the right loan structure is. It's a great subject on pricing. Pricing is very detailed. It's very complicated. It's on a tiered structure. They take into effect your FICO score. They take into effect the type of property it is. They take into effect the use of that type of property. They take into effect the loan amount, whether it fits conforming or high balance conforming or jumbo, and it takes into effect the debt to income ratios at the end of the day. So in my pricing class next Friday, we'll go through all of these, but you've got to realize that if you're the investor and you're lending your own money and you get the guy's tax returns and you can verify his income, you got a safe loan there, right? You're making a decision based on income documents. But if you don't have his tax returns and you're still the lender and you're going off bank statements, and you don't know what's going to happen next month on his bank statements because you don't have it. Well, you do have a track record, but you just don't know. It's less documentation, higher risk. You need to be compensated for that higher risk. So it's got to be a higher price loan. And then if you're not going to give me anything on your income, I'm just betting that with 18 months of reserves, you'll figure this out in silo number 3. So that's even a higher risk loan. So if it was your money, wouldn't you want a higher interest rate? Well, of course you would, because it's a higher risk loan. So yeah, the rates are all going to go up, and it's not defined by 1% or 2% or 3%. It's defined by the deal itself. And that's why pricing gets so complicated. Okay. Next question is, what are the interest rates for this loan now? I just went over that. If you have a specific question on a price on a loan, email me these 3 things or these 5 things, whatever. I need to know the customer's middle credit score. I need to know the type of property, whether it be a single family residence, a duplex, a triplex, or a fourplex. I need to know if it's or a condo. I need to know if it's an owner occupied property, a second home, or an investment property, and probably a name just so we can keep straight on who we're talking about, and I'll shoot you an interest rate. Okay. Oh, and a loan program, 30-year fixed, 15-year fixed, 20-year fixed, ARM. ARMs are generally out of favor today, but you still have access to them. 5/1 ARMs fixed for 5 years. And then for the remaining 25 years, it can float on a every 6-month adjustment. So there's that product also available. Silo number 3, if married woman has 18 months funds and income wasn't necessary to prove, of course, she is in theory could get a loan in her name without her husband with income being on the loan. The complicated question. Usually married people are going to get loans together. If a married person is trying to branch off to buy this property as a rental unit, the answer is no. Silo number 3 is designed for the person who's going to occupy the house, own and occupy, person who wants one roof over his head. That's what the government is trying to do, is to help that particular person. Once you start splitting up husband-wife teams, just email me your question and I'll answer it at a later date on that one. Class Friday with Jeffrey. Okay, there's the next class. What if someone is recently employed, a solid employment, but out of a job for a couple of years? Yeah, it depends on the loan program. If you're doing Fannie Mae, Freddie Mac, then generally speaking, we need at least 30 days of pay stubs to get the loan. If there's a good reason for being out of a job for a couple of years, it would require a letter of explanation. And then honestly, it's really an underwriter's call at the end of the day, because, and I'm certain that there's probably a guideline in that book of 1,200 pages that specifically addresses this question, and we can get to that answer. I just don't have it in front of me. But you got to remember that my underwriter's job is to make sure that that loan conforms to those 1,200 pages of underwriting guidelines. So Fannie Mae buys it from us. So we originate it, we sell it to Fannie Mae under the pretenses that it fits these guidelines. So we just have to make sure that it matches the guidelines. And if it does, yeah, we can do that loan, but still need 30 days pay stubs. Plenty of women have their own money, just an FYI. Gosh, if I said something, Mary, that offended you, my apologies. God, I didn't mean to step on a landmine. Yes, my wife has her own money. It's her money. I get that. She runs her own show. If my wife wanted to go and buy an investment property using silo number 3, that's not available to her. If my wife wants to go buy another piece of property, she would need my consent if she was getting the loan on her own, because through the common laws of marriage, whatever she does affects me debt-wise. So if she runs her credit cards up to $60,000, then I'm responsible for that $60,000 also. So there's these marriage laws that come into place. And again, my apologies if I offended you. I am very sorry. I didn't mean to do that. But yes, I get it. Women have their own money for sure. Okay. Any other questions? Let's see, where am I at here? Remember the email if you would like to participate in a drawing. $25, could at least fill up your gas halfway. As half a tank of gas. It's a cheap lunch for one. God, inflation has just killed us, hasn't it? But it's the best I can do with the laws. Shoot me an email, jeffrey.scott@naf.inc. If you need my phone number, 949-677-1001. I'm text friendly, glad to help out. I work evenings, I work weekends. Can you please show Silo 2 again? Absolutely. Oh, before you go, I want to, let me show you Silo 2 because I promised to do that, but I did want to circle back to something that you want to know about. Silo number 2, no tax return loans, but you still have to prove income. There's 1, 2, 3, 4, 5, 6 ways to prove income not using tax returns. We can use just W-2s and pay stubs, or we can use just the 1099s, or we can just do bank statements, or we can divide your assets by 5 or 10 years, or we can use the income off a rental property, or we can combine and group all those together and find income. Before you go, please give me just 2 more minutes. NAFCAS, so my company is New American Funding. It's owned by one lady, okay? It's $1 billion company. Patty Arvielo is a billionaire. She is the most wealthy Latina woman in America. This is her pet project, NAFCAS. Patty Arvielo's goal for all customers, her goal is to help all customers who want to buy a house to get a house. One of the things customers are experiencing today is a competitive bid situation, particularly in the home prices between, you know, 400,000 or 500,000 to $1.5 million, in that range, and really in particular between 400,000 and 500,000 to 800,000 or 900,000. That is a hot range, and there's generally competitive bid situations, and our own customers are not getting houses that they want to buy today because of these competitive bid situations and people going in all cash. So this is Patty Arvielo, and you can Google her. She's a dynamo in the mortgage industry, and she is loved by the United States government, and I mean that. This is her pet project. She'll buy the house for your customer, all cash in 7 days, and she'll reserve that house for your customer. That's what NAFCAS is. Nobody has this product. Nobody has this, okay? You are lucky to be on this telephone call to hear this from me. And I mean this from the bottom of my heart. Nobody has this product. Patty Arvielo has a company called NAFCAS LLC. When your customer is pre-qualified and we know that they have a loan and can take us out, she will buy the house in 7 days, and you will represent her, and you will be paid your commission in 7 days, full commission in 7 days. And we will also give you a bank statement between $4 to $6 million in the account, so you can show the seller that we can close in 7 days. The only thing we need is a home inspection and a 3% earnest money deposit put into a separate escrow account from your customer to do this transaction. We don't need an appraisal. The reason we need the home inspection is because we got to make sure there's no holes in the roof, no foundation cracks, and no dead bodies in the swimming pool, okay? And I've closed these loans and they work. So NAFCAS, Patty's money, will buy the house for your customer, take it off the market, reserve it for your customer, and then your customer can buy it 10 to 90 days later after their departing house sells. So the benefits to that is that the customer only has to move once, obviously, which is really nice. And it eliminates bidding wars because we swoop in all cash and buy it for the customer. And you can negotiate off the list price by buying all cash. And we've got some statistics that we'll share with you on that. You can buy the new home. We'll buy it for you. The day we buy it, we'll give you the keys to your customer. Your customer can go in there and do paint and carpet and cleaning and miscellaneous curtain hanging. They can do landscaping, anything to improve the house, they're free to do before they close and move in. They cannot tear out the kitchen though, or the bathrooms or the roof or do major modifications, but we give them keys to the house the minute we close in 7 days. The program comes with a 1.0 buy down paid by NAF cash. It's a free buy down to the customer. So the first year, his interest rate is a full 1% off of what we give him. The loan that we give him is a market transaction or less. It is not a goosed up loan. It is not a profit. This is not a profit center for us. This is an accommodation program coming from Patty Arviello's heart. Google her again, read about her, find out about her. She's a dynamo. This also comes with a 5-year rate protection pledge, which means the customer can refinance one time with no repeat fees. Okay. This thing is killing it. If you have a customer that cannot close on a house because they don't have the ability to buy all cash in a competitive bid situation, we've got a product for them. Okay, so chat says, any interest on NAF cash? No, there is no interest on NAF cash. NAF cash is we'll have to get you trained for it. There's a 30-minute Zoom meeting that you can sit in on. If you want to write this down or email me, I can email you the link, or I can actually sign you up. Just email me also if you want to be signed up for the Nash Cash class, so you can be a certified Nash Cash broker. You need it's 20 minutes. No, I'm sorry, it's 30 to 40 minutes. It's a Zoom class. There's no test. It meets Monday and Friday at 11 a.m. or it meets on Wednesday at 1 p.m. So you can take the NAF Cash class, and I can teach you all the costs associated. It's too big of a, it's super easy. It's actually free to the customer if you structure it right. I'll explain that later. There's a lot of moving details, parts. There's 2 transactions going on. Your first transaction is NAF Cash is going to buy the house from the seller. Your buyer is going to dictate the terms and the conditions. We're going to follow the buyer's terms and conditions to the letter when we buy the house. We're going to take title of the house. The second transaction, you're also going to have to write up. So just keep this in the back of your mind. You're going to have to write up 2 RPAs. Your buyer is going to be buying it from the seller, and the seller is now NAF Cash. You will not be paid on the second transaction. You will be paid on the first transaction, the all cash transaction, in 7 days. The second transaction is the accommodation transaction. So the ultimate buyer can get the house. And we let the seller know that we are not inventorying this house. We are selling it to this person because most sellers don't want a company to own their house. Right? They don't want Wall Street coming in there and snapping up their house and making a rental unit. We clearly let them know that your buyer at the end of the day is going to be occupying the house. So super cool program. Okay. Any other questions? I went over by 10 minutes. My apologies. Email me for anything. I work weekends. I work nights. You guys are the best. Thank you. Very, very much. Call anytime. I'm here to help. I love helping. I love my job. We'll talk soon. Thank you.